Joseph's College for Women Autonomous, Vishakhapatnam. Welcome to St. Joseph's open web-based learning platform, So eLearn, for a soulful and enriching e-learning experience. Department of Commerce and Management, St. Joseph's College for Women Autonomous, Vishakhapatnam presents SMOOC, St. Joseph's massive open online course on Fundamentals of Commerce. Fundamentals of Commerce. Module 4 Taxation. Module 4.1 Tax Authorities and Tax Types. I, Mrs. K. Pratyusha, Assistant Professor, Department of Commerce and Management, St. Joseph's College for Women Autonomous, Vishakhapatnam. Learning objectives of tax authorities and tax types. The students will be able to know different tax authorities and their role. Also, identify different types of taxes, direct and indirect, and understand the difference between direct taxes and indirect taxes with relevant examples. Understanding tax authorities and tax types. Tax authorities are essential governmental bodies that enforce tax laws. This presentation explores the roles of authorities such as IRS and differentiates between direct and indirect taxes. Understanding these concepts is vital for compliance and effective financial planning. Let's start with an overview of tax authorities and then delve into the specifics of direct versus indirect taxation, including examples and their implications. Let us see what are tax authorities. Tax authorities are governmental bodies responsible for enforcing tax laws. The IRS, Internal Revenue Service, operates at the federal level in the US, while state tax agencies like the California Franchise Tax Board manage state taxes. Local tax authorities handle property taxes and city income taxes. These authorities have powers to audit, collect taxes, and impose penalties for non-compliance. Understanding their roles helps ensure taxpayers meet their obligation and avoid legal issues. A tax authority, also known as a revenue agency, is the governing body responsible for enforcing and regulating tax laws within a specific jurisdiction. This can include a country, region, or local government. The tax authority ensures that individuals and businesses comply with the tax regulations, collects taxes, and distribute them for public services such as infrastructure and education. It is crucial for individuals and businesses to understand the role and importance of tax authority to comply with tax laws and contribute to the functioning of the society. Also, a tax authority is a government body responsible for managing and administering tax laws within a particular jurisdiction. Tax authorities are also instrumental in policy implementation, working closely with other governmental bodies to shape fiscal policies and maintain economic stability. Let us check out the functions and responsibilities of a tax authority. The role of tax authorities encompasses several vital functions. Tax collection and enforcement. The core function of any tax authority is to collect taxes owed by individuals, businesses, and other entities. This includes enforcing tax laws, identifying non-compliant taxpayers, and implementing measures to rectify unpaid taxes. Enforcement may involve conducting audits, imposing fines, and sometimes legal proceedings. Taxpayer assistance and education. Tax authorities are crucial in educating taxpayers on their obligations and rights. They offer resources, guidance, and support to ensure taxpayers understand and comply with the tax regulations. This educational role helps to build a culture of voluntary compliance, reducing the need of enforcement actions. Policy implementation and advisory. Tax authorities serve as advisory bodies to governments on fiscal policy and tax reform. They collect and analyze tax data, provide insights on revenue generation, and recommend policies that align with national economic goals. Tax authorities support sustainable economic growth and fair tax systems by adapting tax policies to evolving economic landscapes. International cooperation and compliance. In a globalized economy, tax authorities work with international organizations such as OECD and the United Nations to implement and comply with international tax standards such as BEPS, Base Erosion and Profit Shifting Framework. Cross-border cooperation allows tax authorities to address issues like tax avoiding, transfer pricing, and financial transparency. Defining direct taxes. Direct taxes are paid directly by individuals or organizations to the government, typically based on income or wealth. Examples include income tax, property tax, and estate tax. The key characteristic is that the incidence and impact of the tax fall on the same entity. This means the person or entity paying the tax is also the one bearing the burden. Direct taxes are often progressive, meaning higher income earners pay a larger percentage of their income in taxes. Property tax. It is a type of direct tax. Property tax is based on the assessed value of real estate and is administered at the local, county, or municipal level. Its primary source of funding for essential local services such as schools, fire departments, and libraries. The average US property tax rate is approximately 1.1% of the home's value in 2023. For example, a $5 lakh home would incur about $5,500 in property taxes annually. This tax ensures communities have the resources they need to function effectively. Defining indirect taxes. Indirect taxes are collected by intermediaries such as retailers who then remit the tax to the government. These taxes are typically levied on consumption or transactions including sales tax, excise tax, and VAT, value added tax. Unlike direct taxes, the incidence and impact are on different entities. The consumer pays the tax, but the seller collects and forwards it to the government. Indirect taxes can be regressive, affecting lower income individuals disproportionately. Indirect tax is a type of tax that taxpayers pay to the government through an intermediary. The intermediary collects the tax amount and then passes it on to the government. Indirect taxes are transferable taxes since the tax burden can be shifted to others. For instance, if the government imposes an indirect tax on a service provider, this tax burden is passed on to the end consumer, who finally pays it. Indirect taxes fall under the administrative purview of the Central Board of Indirect Taxes CBIC, which operates under the Department of Revenue. There are few examples of indirect taxes in India like sales tax, customs duty, excise duty, service tax, VAT. These indirect taxes are subsumed and replaced by GST, Goods and Services Tax, in 2017. The introduction of GST helped eliminate the cascading effect of multiple indirect taxes and streamline the indirect tax collection process. Excise tax, one of the indirect tax. Excise taxes are levied on specific goods like fuel, alcohol, and tobacco. They are often intended to discourage consumption and can be called sin taxes. The federal excise tax on gasoline is 18.4 cents per gallon in 2024, while state excise taxes vary significantly. These taxes can fund specific programs such as environmental initiatives or healthcare services. Excise taxes impact the cost of targeted goods, influencing consumer behavior and government revenue. Key differences between direct taxes and indirect taxes. Direct taxes are paid directly by the taxpayer based on income or wealth and are often progressive. Indirect taxes are collected by intermediaries, consumption based, and can be regressive. The incidence and impact of direct taxes are on the same entity, while for indirect taxes they are on different entities. Direct taxes are generally harder to evade, whereas indirect taxes are often easier to administer. These distinctions are crucial for understanding tax systems. The major differences between direct and indirect taxes based on different parameters. On what is the tax levied? Direct tax is levied on the net income or profits of the taxpayer. Indirect tax is levied on the sales of goods and services. Next, how is the tax paid? The taxpayer is liable to pay the tax directly to the government. Under indirect tax, the taxpayer pays the tax to the intermediary who then deposits the same with the government. Now, who pays the tax? In indirect tax, individuals and businesses pay direct taxes and consumers pay indirect taxes. Rate. The rate of taxation is based on the net income of the taxpayer. The tax is collected on the applicable slab rate. Rate in indirect tax. The rate of taxation is the same for all taxpayers. Tax burden. The burden of taxation cannot be shifted in the case of direct taxes, but the burden of taxation is shifted from the services provider or manufacturer to the end consumer. Nature of the tax. Direct taxes are progressive taxes, meaning the rate of taxation increases with an increase in the taxpayer's income. Indirect taxes are generally regressive taxes because the tax rate is the same regardless of the taxpayer's income. However, GST is a proportionate tax. Examples of direct tax are income tax, STT, and corporate tax. GST is an example of indirect tax in India. Conclusion. Tax authorities play a vital role in ensuring compliance and funding public services. Direct and indirect taxes serve different purposes within a tax system, each with its own characteristics and impacts. Understanding the different types of taxes is essential for financial literacy and responsible citizenship. Effective tax planning can help individuals and businesses minimize their tax liability while contributing to the well being of society. Both direct and indirect taxes plays crucial roles in economic framework, each with its benefits and drawbacks. Direct taxes are more transparent and equitable but can be complex and discourage earnings. Indirect taxes are broader and easier to collect but can be regressive and hidden in consumer prices. Understanding these differences helps individuals and businesses navigate their financial responsibilities and plan their tax strategies effectively. Thank you.